when you're working in tandem with another job, it's, obviously risk versus reward, right? How much time do you want to actually put in before it's, a detriment versus, a moving forward type or a progression, if you will. So,
welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Catani, and I'm joined today by Hersh Rai. Hersh oversees all business, process, and handlings of RaiVu Capital. They focus on acquisitions and investor relations. As an active investor, he heavily invests in commercial multifamily assets, manufactured housing communities, and short-term rentals across the Midwest and Southeast. With any investment, he hopes to improve the quality of life for his residents, provide favorable returns for his investors, and continue to work alongside experienced professionals who share similar visions. Hersh, welcome to the show.
Jonny, appreciate you having me on, man. Super stoked to be here. Love the podcast. Love what you're teaching the viewers and listeners every single day of the week. Just doing a daily podcast in itself is definitely something to be proud of, and super excited to share content. And hopefully I can add some value to your listeners here.
Oh, my man, I appreciate that very much. Honestly, that means a lot. And we're grateful. I'm sure it's really a bummer having to live in Hawaii, but it is 6 a.m. your time. So we are grateful that you're willing to get up early and jump on the pod with us. But before we get into all of this, you obviously have an awesome portfolio. We're kind of talking offline. Tell us how you got into real estate, what caught your eye, and what led you to where you're at now.
Yeah, for sure. So that's a funny story. So I finished up at the Naval Academy back in 2019. I was 22 years old, and I had the opportunity to go to graduate school right after. And so going from the military mindset into a civilianized institution, you think, your time isn't controlled day to day. And, I'm also getting paid as an officer in the military while going to school, right? So I'm living the best of both worlds, having the ability to actually go do things while in graduate school. So having that mindset, I, enjoyed the time at, Big Ten football games, tailgates, going downtown, enjoying the scene, being a fifth year, if you will, even though I was a graduate student. And, 22 years old, I was like, all right, I need to start focusing on other things aside from, what the typical college student may experience or what the typical graduate student may look for, just because I have more resources to my disposal. So I started to look into alternative investing. Long story short, came across real estate, identified that there were multiple ties to it, promissory notes, tax liens, just reading all these different books, and everything ended up coming back to the tangible asset class that is real estate. And so while I was at Purdue, being in the Midwest, I started listening to Bigger Pockets, and what do, the two hosts of Bigger Pockets say? Midwest, Southeast, those are your best markets. Invest, 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 cash flow, cash flow, cash flow. So I'm like, all right, I'm living in Indiana. There's no really point to look anywhere else because I can drive to wherever I want, when I want, how I want, while I'm here for the next year and a half. So started to look at properties, realized that I just didn't have enough money at the time coming straight out of undergrad to be able to take out a property on my own. Spoke with one of my partners at a dinner conversation, just very casually. We were both roommates at the time. I was like, hey, man, you got money. I got money. Let's go do a deal together. And we ended up just getting really good at deal sourcing. And we decided later on that, buying a single family home for a student rental at Purdue was not necessarily as lucrative as, getting into a larger asset class. And so we started to go to a lot of different meetups in the Indianapolis market, as well as Cincinnati and a couple other, just surrounding larger MSAs, learned about, apartment investing and mobile home parks and, industrial. And we're like, oh my gosh, normal people are buying these. How are they doing it? Right. It's not these larger syndicates or these larger, private equity or institutionalized level organizations that are just picking these up. Like when you think of, these larger hotel chains in like Manhattan, you're like, all right, BlackRock owns all of these, right? It's like, well, that's not true, right? There are other capital groups such as yours or mine who are starting to take down these projects through friends and family investors or, other private equity capital sources. So we ended up connecting, getting good at deal sourcing. That was the value that we brought to a team. We also learned underwriting. So that way it wasn't just, oh, here we found a deal. And we don't want to be that guy who's like, oh, we found a deal, but we don't know what to do with it. So we're like, here's a deal, here's a business plan. This is what our thoughts are. This is what our property manager has already said that we've vetted in the market. What are your thoughts on it? we aligned with, a couple sponsors that we built a relationship with over time during COVID, and closed our first deal in February 21. So 2020 was a learning year, and we finally got one across the finish line as we were leaving Indiana. So, it was
Nice.
a good time. Yeah.
I love it. So was the Hawaii for the Navy?
Yes, Hawaii was for the Navy. Correct.
Got it. Okay. Awesome. And is your business partner out there with you as well, or you guys are now?
No, so we've actually been separate since February of 21. He moved over to Pensacola, Florida. I moved out here to Hawaii. He's actually in flight school right now. So we're both, very into our active duty careers at this point, trying to balance this as well as, serving and defending, if you will. So
That's awesome. I love it. Well, I appreciate your guys' service. That's awesome. And that's awesome you guys are doing both, right? And I know I've had either still active duty or retired military on. I love seeing you guys take advantage of the opportunities that you have, right? You said it a little bit ago. You're like, I have resources at my disposal that most people don't have. How can I take advantage of this? And you did. And look what it's created, which is awesome. And I know that more and more people are starting to take advantage. I imagine that you have fellow officers and fellow active members as investors, right?
yes, absolutely. I would say there's a large portion of people who are starting to learn about, the powers of real estate. I mean, you just talk about the VA loan and, the access that active duty service members and veterans have. And they're just like, okay, I can buy a house with 0% down. How do I do more of these deals, right? How do I get more involved? And, it's just building up that network. It's just organic growth. Once you hear one veteran talk about it, everyone's like, okay, this guy's doing something that I probably should have done during my active duty career. How do I do it? Oh.
Absolutely. I love it. And so now that you guys are no longer in your markets, do you have boots on the ground in the respective markets? How are you guys sort of navigating that? Or are you just relying on brokers?
No, that's a really good question. So we definitely have established boots on the ground in the markets that we invest in. So anywhere in the Southeast, essentially on the I-10 corridor from Mobile down to Panama City, my partner has really good eyes on. He's located in Pensacola, so he's able to drive in the limited off time that he has to be able to go vet these opportunities. And we also have some pretty good relationships with experienced operators in the space that we partner with. Full disclosure here, on every single deal that we've done, we've leveraged other people's experience, whether it be on the management side or the acquisition side of things. And, we've gotten more comfortable being, the full sponsor for the acquisition. But when it comes down to the management, I think a lot more people want that, safety net of a partner who's a little bit more experienced in the market, who has the tangible knowledge of, the day-to-day, right? Because I'm in Hawaii, I don't have the day-to-day of what's going on in the Indianapolis market and the sub-markets of such, right? So we have a really good property management in place. We have, great business partners that we work with over there that, we're able to trust and, continue to grow with. So that's essentially our strategy there.
I love that. That's so smart, right? Especially when it comes to asset management. I've said it before on this podcast, it is such an under talked about part of the business. And I think part of why it was so under talked about is because really for the last 2 years, you honestly could have fired everyone in asset management and still 2 extra deal, right? And so nobody really talked about it because not that it wasn't necessary, but the markets kind of just took everything. But now it's becoming the most important part because you actually have to run a business now. So
right,
having that where you can, leverage good asset management, which of course is going to lead to good property management, is huge. And of course, that takes a ton off of your guys' plate and allows you to, basically live outside and have, completely other jobs going on. So what does your day-to-day look like in terms of the business and even some of the assets that you are already involved in?
Sure. So, day to day, it just really depends on, the day and also how, the W-2 or the active duty job is taking place, because that's first and foremost. But a typical day, or a typical week, let's just frame it that way. We'll have our, internal sync between my partner and I and a couple of the other individuals that we work with, just some junior partners, if you will, that we've brought on that are just doing some of the deal sourcing for us. We've been heavily involved in a new development project now for the past year. So that's been taking a large bandwidth of our time. It's the largest deal we've done. You're talking about 30 to 35 million, for the complete build cost. So that's a large equity raise. And, getting everything in line to be able to actually go through with the full build is taking quite some time, but we'll talk about that in a little bit. Day to day, like I said, internal sync, identify what we need to get done for current projects. Are there anything that we need to do for, further stabilization that our partners may need help with? So like I said, once we do an acquisition of the project, we take a very backseat role in just learning about the asset management. So that way we can, better perform on future deals. And that's what we're doing with on this new development deal. So, we'll just send a quick ping, whether it's via text or via email to a couple of the other groups that we're working with on these projects and to say, hey, what are the accomplishments for this week? What are we looking to get done? Is there anything you guys need extra help on? So, we send out, an investor relations video every month for, different investors for different projects, just giving them a highlight and, sending them financials, answering questions. Others may be, looking at and vetting different opportunities. We're looking at a couple opportunities every week, whether it's, multifamily or mobile home park or even, new development potential for, land. So, it's basically just vetting deals, contacting partners to see what's going on and when it's going on, and seeing how we can expand the business. I mean, even when we're not extremely active on social media, which we haven't been nearly for the past 6 to 8 months now, we still have a large amount of people who want to, be able to talk to us and learn and grow and, see what kind of opportunities we have. So, those types of things. I'm sure you're seeing a very similar thing. I'm not sure if you're full time or not, but, when you're working in tandem with another job, it's, obviously risk versus reward, right? How much time do you want to actually put in before it's, a detriment versus, a moving forward type or a progression, if you will. So.
Yeah, absolutely. I am full time. Full time in real estate, but totally understand. And yours is kind of forced, right? It's not like I mean, certainly, obviously, you want to replace your W-2 income, and I imagine even more, right? Ultimately, but it's not like you can do that as soon as it's replaced, So yours is definitely an interesting scenario, which I know, I'm sure you probably have mentors in the same scenario as well, because I know some well-established people in the community have pretty much done what you're doing, and that's nice to kind of have that roadmap. And this is an awesome segue, because the next question was going to be, what are you guys working on? So you're working on a development, which is fascinating in these economic times, right? You don't typically hear of a lot of development, typically because lenders are kind of turning away development, just the risk thing. So talk about the deal if you can, and what you guys are doing.
Yeah, sure. So this is a long-winded answer, but we'll keep it as short as I can. So September of 2021, we were in the middle of mobile home park deal sourcing and acquisitions. We came across a site in Panama City, Florida, right? So ding, 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 you automatically think spring breakers, right? Panama City Beach, Destin. And so we did a little bit more digging and come to find out that mobile home park was completely disheveled back in Hurricane Michael in 2018. The previous owner hadn't taken care of the land, hadn't done any material improvements. So we ended up getting in touch with the local broker. And as we did that, somehow the local city got our information, not necessarily sure how. Maybe it was through the broker, maybe it was one of my partners who contacted the city, but the city essentially told us, they're not going to rezone this as a mobile home park and it's non-conforming use. They want to see a new development take place. So we did a little bit more research into the actual site. And, it was about 5 acres, and they were willing to support about 100 units on there, 20 units an acre, pending wetland mitigations and things of that. And so it's actually 2 miles north of Tyndall Air Force Base, which is, the next generation of, fighter jets and things that are going to be moved to that base. So, you have 5,000 new jobs coming to the area. And, being in the military, which we obviously understand, it's a huge resilient, type of market once you know what type of development dollars are going to be going there. So we said, 5,000 new jobs just for the military and service members alone. What about contractors? What about support staff, right? There's all these intangibles that people don't necessarily know about. So we did a market study and we learned a little bit more about, absorption of units, how much supply is going to be available, what other home builders and what other entities are building. So we saw like DR Horton's building there, Lennar's building there about 2 miles away from our site. So we're okay. Larger people are building in this area. What are we missing here? So we decided to put under contract. We've probably come across every single problem that we can for this deal that we could have imagined,
Classic.
anywhere from boundary line agreements to easement impacts to wetland impacts, to, the site being too small. So where are we now? We finally, expanded out to about a 10-acre site. We ended up talking with a local church group who decided to sell us part of their land. So we promised them X amount of money so they could, go use it toward renovations and whatever they may need to support the local community. So, we're giving back to the community in a sense by acquiring land in order to provide, affordable quality housing for the residents of Panama City. And so, 160 unit development, 4-story build. We're partnering with a pretty established construction team who's done mainly industrial and mixed use throughout the Southeast. So, they're going to be bringing in that construction experience. We're going to be bringing in, our acquisition and asset management experience. But again, this is a learning curve. Never done new development before. So to speak on your lending side, I think, we have a lot more conviction just because we're partnering with that experienced developer and that experienced builder, right? Just because they may not be institutionalized doesn't mean that they don't have a track record that is able to perform in this area. So, as long as we show the lender or, wherever we source the debt from, what the strength of the market is, why it's resilient through a downturn, and why it's going to be able to be completed with the resources we have in place, I think we're going to be able to transact on this project. So total build cost about 35 million. Post valuation should be anywhere between 55 to 60 at, a low type cost. And, business plan right now, build, refinance. Once the certificate of occupancy is granted, then long-term hold, but who actually knows what we're going to do? It's such a fluid process right now that, we're looking at different exit strategies, maybe building in phases, maybe not, just to, like you talked about, alleviate that risk, right? Maybe the builder doesn't want to do the whole 35 million upfront. Maybe they want to just do 80 units and then 80 units or 40, 40, 40, 40, right? So, taking those types of things in consideration as well as what we're doing. So,
yeah. And development is a completely different animal, all the way from the initial stage underwriting. I mean, it's so different. You got feasibility studies. I potentially was going to be doing one here in Utah for self-storage. So I understand a little bit, much smaller project, but still can understand how sometimes it's so overwhelming. So it sounds like, what is it going to be, Class B or Class A, or what are you guys
it's going to be Class A. It's going to be Class A. And, what we're going to try to shoot for is, catering to that military population, just because there's so many different people coming. And, this is like a 7 to 8 minute ride from the main gate. So you're going to have a lot of service members who are going to say, like, I don't want to live on base, but I want the amenities of a nicer place with the access to base that I may want to have later, because, a lot of the base members go service, or shop at the commissary, they shop at the Air Force Exchange, because it's tax-free and it's cheaper. So, just being able to deliver that, we're looking at, the basic allowance for housing rates that the military has, trying to project, what our target is going to be. Are they going to be roommates if they're, active duty service members who may be, junior officers or, junior enlisted service members, or are they families, right? Okay, maybe they want the 3-bed. Does the 3-bed rent cover that, basic allowance for housing? Or the other way around, does that basic allowance for housing or BH cover that? So, we're catering to these things as well as just looking at the larger demographic and seeing what affordability exists. We're not looking to skyrocket rents here just to make it unaffordable for every single other person, just because, we want to have an existing product that benefits the community at the end of the day. So,
absolutely. I love it. So kind of take us through then, what would be best case scenario for you guys, for investors, and then, maybe a couple of the exit strategies, kind of the plan B, plan C.
Yeah, sure. So it really just depends on, like I said, what we're looking at for the project. So, we're still sourcing the equity. We're looking to bring in, 1 to 2 larger high net worth capital partners that we have in our network. But as you know, capital is king right now. So the capital providers or the equity providers are the ones who are going to dictate the terms.
Yep.
We're not at the level of institutional level type money where we're saying, okay, these are the returns you're getting, and this is how the deal is going to work. It's like, okay, here's the deal we have. Yeah. Here's the opportunity. You guys,
they're going to tell you. Yeah,
exactly. So, it just really comes down to, what type of return they're looking for. Are they more on the capital preservation play where they're looking to close on a large term? long-term acquisition and construction loan by the end of the year to have tax write-offs, or are they looking to close next year, with these types of opportunities? So a couple different strategies. One could just be, they come in and they just want to buy the land outright. And if they have their own development arm that they want to work with, then, by all means, they can go ahead and do that, right? I mean, we're not by any means disposed to just going through with the full development. So it's like, all right, if you want to buy the land fully entitled as is with the development order in place, it's a basically risk-free site. Just do amendments to whatever you need to the site plan and then move forward. So there's that, considering they have development experience. That's one. Two, we can go through with the full stage development and, get the build done in potentially 18 to 24 months. That's taking into account a 3 to 6 month contingency, obviously. And then getting their certificate of occupancy granted. And what we're planning to do, since it's 4 separate buildings, if we go through the full phase, is lease up as we go, right? It's not just going to be, hey, wait till HALA 160 are online and then move forward. It's like, okay, let's do the first 2 at 80 with the clubhouse. Leasing office is done. We have individuals ready to go. We have management in place. Okay, cool. Let's get this leased up. Let's start pre-leasing. Let's get the marketing ready, etc. And then, we can start doing it over time. And then once that certificate of occupancy is granted at the 80 to 90% mark, all right, great. Do the refinance, potentially return majority of principal, if not all, to the capital investor, and then, hold and potentially sell after that 3 to 5 year seasoning period. So that's another strategy. But then we could also do a phase development where we do phase 1. We prove out, okay, here's 80 units. This is what the buyer consensus or renter consensus may look like. Here's a development opportunity for, someone else who may want a proven out concept with a little bit less risk profile. Okay, cool. This is what they've shown in the market. Maybe we can go do the same thing. So like I said, multiple exit strategies, multiple opportunities. But, for me, I think personally, I would love to go through with the full scale development. I think, being able to do that development, not only for the return profile, but for the intangibles, right? I'm talking about adding it to your resume, having that ability to say, I worked on a $35 to $40 million renovation, not even renovation, excuse me, $35 to $40 million new build, right? Ground up. And, that opens people's eyes because it says, okay, what experience do you have? You're like, okay, well, I wasn't a majority equity owner, but, I basically ran the deal from A to Z, right? And far in between. So, that's what we're hoping to do. And again, it all comes down to where the market is currently at. We're pretty confident in the team that we have. So we're looking to execute here pretty shortly, just, waiting on a couple things to be finalized in the development order and getting the entitlements buttoned up, if you will, before we're able to break ground and get to it. So
that's awesome. I love it. And congrats. I mean, that's going to be a killer deal no matter which way you swing it, right? But I'm with you there. If you can ride the whole thing, ideal scenario, to stick with it, like you said, man, that when your name in terms of like your capital group is on something like that, it just, it makes a name for yourself, right? And the right people notice, especially if you're getting institutions involved. It sounds like some of your partners have experience with institutional money, which is why the institutions are taking
correct. So
okay.
So we have some internally that we can tap into. I'm not saying, they've ever invested with us just because we're, a smaller boutique shop and we don't necessarily have hundreds of millions of dollars worth of assets under management. But that construction team that we're working with has also, brought on a level of experience in acquisition as well. So they're able to both do the construction as well as the acquisition. So that's giving a lot more people open mind, if you will, to different PE and institutional level type money to be able to come in and say, okay, maybe we can write the check for the whole thing, if not majority of the equity. So we're
awesome.
Shopping it around right now and seeing who we can best align with. So
yeah, absolutely. I love it. Well, this has been incredible. Love the insight and really stoked for you guys. Love seeing development. Obviously tons and tons of yield. That's where most of it is right now too. As the market's kind of shifting around, I think here over the next year, we're going to see some prices plateau, some markets come down, back down to earth for sure. Take out your fuzzy crystal ball. What do you kind of see as happening as well economically, just in the commercial world?
Sure. So, just from a macro perspective, I think we're going to be entering a, deeper recession than people think, especially from where we're at right now. I don't think inflation is going to be tamed down. I think with the holidays coming up, people still love to spend, People still love spending money they don't have. Credit cards are still widely available for individuals to use. It's not like you've seen credit card applications decrease. Just because mortgage applications are doesn't mean credit card application discretionary spending is decreasing. Just from the Airbnb side of things, we're still seeing a large amount of volume coming in with bookings, right? So that shows me that discretionary income is not necessarily as, important for some people right now as it may be in 3 to 6 months. So what I'm seeing right now is, about 50,000 jobs have been relieved in the tech world. Okay. So tech world is starting to hurt. As the tech world starts to hurt, you're going to start seeing a lot more prominent spaces in banking and energy and retail start to take a nosedive, coming in with different earnings. So in the commercial world, I think interest rates are going to stay stagnant. This next increase is going to occur, pending the November 1st Fed meeting. I think we may hold for quite some time. I think interest rates may peak around 10 to 12%, just for that higher term construction type debt. For maybe longer term acquisition holds, you're looking at 8 to 9% max is what I'm seeing. I think you're going to start seeing tame down in Q4 of next year and moving forward in 2024. You might start to see a bell curve start to stabilize. But aside from that, expect 2023 to be a year of make or break. This is where you're going to either make your money like the 08, 09 guys, where you're going to say, okay, I survived the downturn. I made money. What am I buying? Hint, look at midterm rentals. If not, then, you may lose a lot of money because you bought a house at $100,000 above ask in 2020 because the interest rate was 2.5%. And, sorry to say, but sometimes it happens. So those are my thoughts. I'm not sure if you're in agreement, but those are.
Yeah, no, I love it. I literally 100% agree. That's my exact sentiment. I think that's a pretty common one now. I think 3 months ago, it was very up in the air what was going to happen. I think even though we haven't seen the top of interest rates, I think we have a better understanding of what's going to happen, right?
Right.
This is the only lever they can pull. We've got at least one more. It sounds like even another one in December, although some economists don't think they should do that. Personally, I think if you're going another 75 basis points, I think letting things catch up would be the right play. But right. They only have one lever to pull. So they're just going to keep pulling it till something breaks because that's all they know. That's all they can do. So that's kind of what I think.
I agree with you. And again, we're not the high level decision makers, the economists who get paid the big bucks to do these things. But, I think just largely there's going to be a correction. And once people see it, they're going to say, oh, that's what people were talking about for the past 12 months. But until then, look, just for the listeners, stay grounded, stay true to your numbers. Don't try to make anything work that doesn't work. Yep. And always underwrite knowing that a long-term rental is going to be the default in any market, right? That 12-month lease locked in at a fixed rate is what keeps people breathing at night and sleeping at night. So, understand that's what your value is. But if you need to pivot into short-term and midterm or different types, just know that you need to always underwrite to the worst case, which is, a long-term lease with vacancy. So putting that out there.
Yeah, I love it. And that's the conversation that I'm having for this short-term rental portfolio is, obviously in the beginning, right, this is what it's doing now. Like you said, demand is still high, still getting, rates are still increasing in the STR world. It's insane. Yeah. And you can still find some value, right? You can still find some single family residents, especially in a lot of markets. It's starting to come down in that space. Yep. Despite this being a commercial, technically asset and portfolio, you are still having to go into the residential space. You're still seeing good long-term debt. A lot of these that they're purchasing for the portfolio are getting 10-year fixed rate, 30-year AMs, interest only. Like you're still seeing good debt.
Yes,
interest rates are going up, but it's still relatively. Are the 3.5% gone? Yes, 3.5%.
Yes, absolutely.
But 7, 6.5, 7 fixed rate. It's not killer. It's not killing deals.
It's not. I just got quoted last week for a mixed use project in New Hampshire for 6.82, 25-year amortization, 75% loan to value. It's not terrible. I can still make money on that. Right? Because it all depends on what you're buying at and what your value creation is going to be, if not turnkey, right? So just play to your strengths, identify your weaknesses, fill in the weaknesses with the team, and there you go. You're going to have a fully strength team. So.
Yeah, I had a guest recently tell me to date. What did he say? He said date value or date interest and marry cost basis.
There you
So
go.
like if you're buying at a low cost basis, your value can be stretched out. You don't need to walk in and increase instantly. Everything needs to go up 20%.
Right.
Especially when you've got a long-term mindset in play, and you can always refinance. I'm with you. I do think interest rates are going to start coming back down by Q4 of next year, at the latest Q1 24. I think you're going to see I think the Fed's going to see what they want by early, maybe late Q2 of next year. I think they'll start to see that decrease in the CPI that they want to see. And then we'll just kind of ride it. Things are going to slow down. If you're new to the space, find good partners. Like, don't try to go into what's about to happen on your own. Agreed. Now is the time to find partnerships. Take a small percentage versus a large chunk, because if you go out taking large chunks doing your own deals, oh man, the downside risk is so high there that I wouldn't do that. Even as someone who's been in, for a couple of years now, I'm still partnering and leveraging, like, just like you guys, right? Like, it's not time to go out and do your own deals unless you have that track record and that experience.
Right. No, especially if you're looking to put other people's capital at risk. Don't say, "Hey, mom,
please
dad,
don't."
Yeah, exactly. I have this opportunity." It's like, no. Wait, who are you partnering with? What's your track record? Right. Just identify the strengths, like I said, and, be able to conquer your weaknesses with that partnership. It's definitely very important, but.
Totally. I love it. Well, this has been incredible. So much value. Love the conversation. We'll go ahead and wind down here. We'll jump to the final 5. First question, best advice you've gotten from a mentor?
Best advice I've gotten from a mentor. That's really good. Oh, geez, there's so much. I think the best advice I would say is always move forward and take an L, as they say, as not a loss, but a learning opportunity.
Yep.
That really stuck with me. I think one of my mentors was just saying, what does an L define to you? And I'm like, it's a loss. Obviously, it's just not something you want to do. He's like, no, it's a learning opportunity, right? What are you going to learn from that in order to better yourself and those around you so you can move forward in a positive fashion? And that has just helped me shift my mindset, where it's been, doom and gloom after, something may go awry, to, okay, I'm going to be in doom and gloom for maybe 2 to 3 minutes of my time, but it's not worth just taking all my energy out of me. How do I focus on what can I move forward with next? What is in my control, vice what's not? Take action on what's in your control and let whatever else needs to play out. Because at the end of the day, you can't control everything that happens in life. Life moves on without you, regardless of what you want.
1,000%. And in 5 years, I mean, I'm not going to go full blanket, but in 5 years, the lessons, the L's, they really are so insignificant.
Yeah.
I mean insignificant in the sense of, in 5 years, you're not going to look back and be like, oh man, I wish I had, the X amount of dollars I lost in that deal. You're going to be like, I'm really glad I learned that lesson when I did, because now I know how not to do that thing. And now Look where I'm at 5 years later. I didn't make that mistake again. And I'm exponentially farther ahead. And that's how I feel with my, failures, mistakes, lessons, is they suck in the moment, especially in this world. It usually involves money, and it usually involves a loss of money. But like I said,
it's life.
Yep, it is.
It's life.
Totally. I love it. What is about your career that makes you feel like you're fulfilling your why?
I think just being in the military. I mean, there's a reason I decided to, go to the Naval Academy and serve. I have an immigrant background. I came from India with my parents when I was 4 months old, and, was always told that, don't take any opportunity for granted. Thus why I also ventured into the real estate space, giving other people the opportunity to invest alongside me. But, being in the military has fulfilled a larger purpose, I think, and, serving alongside others who, want to serve and, give back to the nation. It's just been an extremely humbling and rewarding experience, top down and bottom up. So.
Absolutely. I love it. Again, grateful for your service. I have a longtime family friend who was in the Naval Academy. I've been out to Annapolis a few times. Absolutely gorgeous out there. Love it. Army Navy games. If you,
oh, geez.
I mean, just if you're a sports fan, you need to experience an Army Navy game. I mean,
Absolutely.
absolutely incredible. It's just, or even just going and visiting the campus. It's absolutely beautiful. Favorite non-real estate or investment related book?
Favorite non-real estate or investment related book? I would say What It Takes by Steve Schwartzman is a pretty good book. It did start off with, leverage buyouts, but Steve Schwartzman is the founder of Blackstone. He is a prominent individual who talks about, how he started, in, undergrad, going to the Army during Vietnam, and then I think it was Vietnam. Yeah. And then moving over into, Lehman, and then transitioning into what is known as Blackstone today. I mean, incredible story, how he, has leveraged, foreign markets and, institutionalized level money from other nations. It's just incredible read. It really opens your eyes up into saying, okay, you're doing real estate, but how can you expand into this like visionary company, right? It's just great book, great guy, love the book, love the atmosphere. And I just recommend it to anyone I come across in the world. So
it's awesome. I love it. Gotten that before, so that is definitely on the list. Look forward to reading that one. If you could have any superpower, what would it be?
Any superpower. I think the ability to teleport would be incredible. I think, just the idea that I can go anywhere I want when I want with the flick of a finger would just be awesome. And I mean, it would definitely help for due diligence.
I was going to say, I was literally just going to say that. Imagine due diligence. You're like, oh, I'll be there in 6 seconds.
Exactly. It's like, I'm out in Hawaii. Hey, I'm going to just step out for lunch real quick. I'll be back in an hour, show up in Little Rock. I can snap my fingers. No, I think teleporting would be so cool.
Yeah, that would be huge. It saves so much on your business expenses as well.
Yeah, it's just the time element, right? It's just, flying from Hawaii to the East Coast, like a day of fare. You're like, okay.
Yeah, man. Holy cow.
Yeah,
because you leave like 8 a.m. your time and you get there like 8 p.m., not like 10 p.m. Oh man, brutal.
Yeah. Oh yeah. You're getting there like the next day at 8 a.m. really, because it's like, you're 12 hours of travel time and then 6 hours ahead, and factor in layovers. It's a lot. It's a lot. So
yeah, that's a commitment. You got to be like, all right, we're going out for a reason, staying for a bit.
Exactly. It's usually a week affair when I go to the East Coast.
Yeah, no quick trips.
No.
Coming from Hawaii.
No.
I love it. Cool. Last one. What's the best way for people to get a hold of you and learn more?
The best way people can get a hold of me are two ways. LinkedIn, first and foremost. It's Hersh Rai. I'm the only one on there. HERSHRAI. Very easy to find me. 8 letters, no middle name. Or you can email me, Hersh@RaiVuCapital.com, at RaiVuCapital.com. So
Sweet.
More than happy to connect. Yeah.
Hersh, this has been amazing. Thank you so much for your time. Thanks for getting up early, even though I'm sure you're probably an early riser already. We're very grateful. Thank you.
Jonny, appreciate you having me on, man. Enjoyed the conversation. Talk soon.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.